Today, we are going to take a look at Airbnb. It has been up significantly over the past month, but it is still down 30% year to date. We will analyze the company's financials, read their latest quarterly earnings result, and then try to come up with a fair value by calculating an internal rate of return based on the free cash flow of the company. First of all, we will start with a little bit of information around the company. Airbnb was founded in 2008, and they already have a market cap of $76 billion. Their mission statement is simple: to help anyone belong anywhere. And that really fits with their business model. It's an online marketplace to find places to stay and things to do. They make their money through two different things. You can either book a stay on Airbnb or an activity. And in the last years, Airbnb has become kind of a generic brand name. Whenever you say that you are booking a house to stay in, you just say that you are booking an Airbnb, which shows us that there is a moat for the company. We also have the network effect working in favor of Airbnb. With an increased number of people offering their house on Airbnb, the service gets more interesting for customers. With more customers, it gets more interesting for people to offer their house on Airbnb. Now let's take a look at the latest quarterly earnings report. There are two important metrics for Airbnb. Nights and experience booked, it's up 25% year over year. It just adds the total number of nights plus the number of experience booked within a quarter. Gross booking value shows us the dollar value of all the money that flows through the platform. This figure was up 27% year over year. When nights and experiences booked and the total gross booking value grows in the double digits, we can expect revenue to also grow in the double digits, which is exactly what happened. Revenue was $2.1 billion, up 58% year over year. And it also exceeded their 2019 results by 73%. The company also had their most profitable second quarter with a net profit margin of 18%. They had a net income of $379 million, up $676 million compared to Q2 2019. Which shows us that the company managed to get profitable. That's because of the high revenue growth we just saw and their low expenses. All recurring operating expense line items increased more slowly year over year than revenue, allowing for considerable margin expansion. This also leads to a positive free cash flow, which I really like to see. Especially in times of high inflation and with rising interest rates. Companies with a high positive free cash flow tend to outperform the market. This makes a lot of sense because those companies don't have to borrow money and they don't have to issue new shares when the market is down. They can even use their free cash flow to buy back shares, which is exactly what Airbnb started doing. They just announced a $2 billion share repurchase program. For the company's upcoming quarterly results, they expect a year-over-year revenue growth between 24 and 29%. This revenue outlook already includes a significant headwind from foreign exchange fluctuations relative to last year. In the quarterly earnings from American Express, we have just seen that the travel and entertainment sector kept growing strong despite the economic headwinds. This could be an indicator for Airbnb's upcoming results. So we have just seen that the company has been able to get back on track with their growth after 2020. And based on the numbers we just saw, I think it's reasonable to expect the company to keep growing in the next years. Their total addressable market is $3.4 trillion, and right now they only have a 1.3% market share. So there is still a lot of room for expansion. Currently, Airbnb is trading at a PE ratio of 54 and a forward PE of 47. In the past 5 years, their revenue grew 30% year over year. When we include analysts' estimates until 2025, we can see that the company is expected to grow its revenue with a compounded annual growth rate of 17.8%. Free cash flow is expected to grow faster than revenue, which is often the case when high-growing companies scale their business and get operating leverage. Before we get into valuation, if you like this video so far and want to see more stock analysis videos, it would mean a lot to me if you would subscribe to the channel. Now let's take a look at our normal case scenario for valuation. In this case, cash flow will grow slightly above revenue and decrease every year as our projections get more and more uncertain. A fair free cash flow yield of 6% already seems a little bit conservative, but who knows what will happen to the traveling sector in the next years. And it is still a young company, so I'd rather stay a bit conservative with my subjective numbers. But we can see the internal rate of return is 14%, which would definitely be a market-beating return. When we take a look at the forecast market cap, we can see that with this kind of growth year over year, the company would be worth over $200 billion. This is a very high number, and we have to keep in mind that all our growth estimates are assumptions. If something happens to the company and they have a huge cost increase, for example, this scenario wouldn't happen. but I actually believe that the growth numbers are reasonable. In the best case scenario, I just elevated the growth number slightly and we obviously get an even better internal rate of return for the stock with nearly 17%. So now we have seen that there is a huge potential upside for the stock. But it's always important to think of the risk and reward. And the worst case scenario represents the risk of a stock. I decreased the growth rate very fast. And you can see that in this case, the company even stops growing in the double digits. And I use a very conservative free cash flow yield of 8%. But there's still a probability of an 8.7% internal rate of return, which is in line with the market, maybe even a bit above the market return. This brings us to our combined result, which gives us a potential internal rate of return of 13.8% at the current price. This is no financial advice and you have to do your own research and make your own decisions. But I personally like the stock at the current valuation. We have seen that there is a huge addressable market and even with a lot of economic headwinds, the company keeps growing in the double digits. They have low debt and a positive free cash flow, so there's a very low danger of bankruptcy. I'm a buyer of the stock right now, but although the assumptions we made are conservative, I personally will still try to keep the position in my portfolio small, as there are risks to the traveling sector, like we have just seen in 2020. This has been an analysis of AirBnB stock. Thank you for staying till the end. If you want to see a stock that I also like, I recently made an analysis of Amazon. Just take a look at the pinned comment below to watch the video. So goodbye and see you in the next one.